Dominic Pappalardo, Chief Multi-Asset Strategist at Morningstar Wealth. Morningstar recently published its 2026 Global Outlook Report covering economic and investment themes. What are some of the key insights from the report?
Hey, Chris, thanks for having me. Three main themes that I think are very relevant for this conversation are the AI environment, kind of the capital investments taking place there, the massive build out that we've seen, the way that those companies have been rewarded by the market in the last couple of years. Certainly, heightened levels of uncertainty, thoughts and ideas about how investors and advisors can prepare for that uncertainty, what they should be thinking about, ways to maybe protect a portfolio from some of that. And then a big theme at Morningstar has been the public-private market convergence that's taking place. And Morningstar, given its background in manager research and kind of asset class research, is well positioned to offer some thoughts and guidance around that.
All right, let's jump in. For the AI arms race, what are some of the key considerations for investors?
Yeah, I think the biggest question that we get from advisors and clients out there, Chris, is it a bubble? And that's not necessarily easy to answer because everyone's definition of a bubble is a little bit different, and that's totally fair. The way I answer that question is I like to say not yet. And what I mean by that is the companies that have done very well from a stock market perspective related to AI have seen significant revenue growth and earnings growth. So it's hard for me to say we're in a bubble if the fundamentals are in some ways keeping pace with the stock price appreciation. Now, that can't continue indefinitely. At some point, in my opinion, the buyers of AI technology will have to be rewarded. So your typical company that's investing in AI for their day-to-day operations, they really haven't realized a meaningful return on that investment yet. Sure, there's been some efficiency gains or maybe some slight headcount reduction, small things of that nature, but certainly nothing that justifies the massive investment we're seeing into AI. So it seems like until we know if, when, and how those buyers of AI will be rewarded, it's difficult to project how far into the future the sellers of AI have been rewarded. And by sellers, I mean the infrastructure providers, the companies building and providing software and hardware and kind of the input components, NVIDIA, Microsoft, Amazon, Google, all those companies. So I think for 2026, the capital investment is on the books. There's backlogs in all those areas, so I don't expect any type of pullback or sell-off, so to speak, in 2026. But at some point, the buyers of that technology have to see real returns on their investment for it to continue into the future.
It seems like there's some uncertainty there. Talking about uncertainty in general, how can investors navigate that uncertainty without overreacting in their portfolios?
Yeah, I think it's a really relevant question, Chris. There's a lot going on right now. If you just look back at 2025, we had many surprise headlines. I think first and foremost was the Liberation Day tariff announcements back in April of 2025. We saw a massive market reaction to that almost immediately. What was interesting is that market reaction then reversed very quickly. If you go back and look at what happened, there were really only about 8 trading days where the market was down significantly. So you had a very small window to try and jump back in. And what that reminds us of, it's very difficult to time markets. And at Morningstar, we would always advise investors to have a thoughtful, diversified portfolio construction plan and then stick to it independent of what the headlines may be doing to markets. That's more relevant now than really any time in history. Like I said, Liberation Day tariffs are a big deal. We have a lot of change coming in 2026. The makeup of the Federal Reserve Board comes to mind. There's probably 3 to 5 new members coming on to the Federal Reserve Board in 2026. That will obviously have an impact on fiscal and monetary policy going forward. It's interesting because people always try to predict what the Fed's going to do in the future based on their dot plot. But if 3 to 5 of the members providing those dots go away, then I'm not sure how much stock we can put in kind of the Fed's own forecast at this point in time. And then we have just general geopolitical headlines, which, as we just saw even this past weekend, kind of popping up, I wouldn't say out of nowhere, but perhaps at a larger degree or bigger scale than maybe people were expecting. So again, it's that concept of preparation, not reaction. So if you could stay ahead of this, have a thoughtful portfolio strategy that you have the discipline to stick to, typically those are the investors that do best in times of uncertainty like we're dealing with right now.
Excellent. And finally, something that both investors and wealth managers alike should be following is the rise of private markets as
Mhm.
accessible vehicles. What should they be thinking about in terms of risk and opportunities there?
Yeah, private equity and private credit have definitely gained a lot of momentum in the last few years. There's certainly advantages to those markets, and there's certainly disadvantages to those markets. At a very simple level, the biggest disadvantage in our view is the lack of liquidity that comes along with those investments. Most retail investors are very used to daily liquidity, whether it's an ETF, a mutual fund, individual stocks. They put a sell order in today, they have the cash available tomorrow for whatever they need. That's not how private markets work. Many of the vehicles that are being thought about for mainstream investors might have monthly liquidity at best. That's not something retail investors are used to. And clearly, if you have a situation where everybody's heading for the exits at the same time for some reason, those problems will be compounded by the lack of liquidity within those markets. And I think historically, institutional investors, whether that's pension funds, insurance companies, things of that nature, they've learned how to deal with that. They maintain, portions of their portfolio in those private spaces, but they also ensure they have sufficient liquidity resources for when they need them. I'm just not sure that individual retail investors are comfortable enough with that mindset or can be thoughtful enough about that to safeguard themselves against the potential drawbacks of those liquidity constraints. The upsides have been, fairly simple. Historically, private equity and private credit have done better in some ways than their public counterparts have, and that's sort of accomplished through kind of the lack of mark-to-market pricing, so they don't have wild fluctuations day to day or hour to hour as individual stocks might. So they perhaps have been a bit less volatile historically, and that seems appealing to investors. But again, it's really important that investors understand trade-offs like liquidity that they're taking on to potentially realize that additional upside.
Dominic, these have been very useful insights. Thank you for your time.
Thanks for having me, Chris. Good to speak with you.